Then I'll tell you what changed my whole life when I finally discovered it's all risky. The minute you were born, it got risky. If you think trying is risky, wait till they hand you the bill for not trying. If you think investing is risky, wait till you get the tab for not investing. See, it's all risky. Getting married is risky. Having children is risky. Going into business is risky. Investing your money is risky. It's all risky. I'll tell you how risky life is. You're not going to get out alive.
Okay. Investing can be a daunting prospect. With an enormous variety of possible assets to add to your portfolio, not guarantees for profits, and the constant pressure that time is of the essence, a lot of people are battling with fear, uncertainties, and doubts. Did you bought too late? Did you miss selling at the top? Questions that only time can answer to, but the path for financial freedom is paved with informed decisions and with a little bit of risk tolerance. Hi, I'm Sherban, one of the developers behind Moondotter's NFT project, and today, together with my friend and the mathematician I admire the most, Hugo Chavez, we'll share our perspective in this topic and give you a glimpse of the tool we are using in guiding our investing decisions. Hi Hugo, how are things for you?
Hi, Sherban. Doing good. What about you?
I'm fine, looking forward to our conversation. Um,
Yes, me too.
Tell us a little bit about your background and how did you came up with this idea of inventing your own tool to make financial decisions?
Yes, so I'm a Portuguese mathematician living in the Netherlands. My original background is in aerospace engineering, but my job and much of my studying since then was in math. So nowadays I'm more of a mathematician than an engineer. The reason why I started developing this tool, and well, first and foremost, the reason why I started thinking about investing was because I had a few thousands of euros in my savings account, and I got an interest of 6 cents at the end of it. So that made it very clear that this was not a very interesting strategy for investing. And as such, I started looking more seriously into investing myself. Now, I don't really have a background in finance or in economics, so I cannot say that I trust myself to make informed based decisions. I don't have the knowledge, I don't have the know-how to do that. And as such, what I thought that would be an interesting strategy would be to use my strength, which is mathematics, to try to develop a tool that would help me make sound decisions. What is also important here is that I do have a full-time job, and as such, I don't want to become a full-time investor. And because of this, my main focus was on investing on a longer term. I don't know, a few years, 5, 10, 20 years ahead. And that was my priority when developing this tool, to have a tool that would help me make better informed decisions on the longer term to compensate for my lack of experience and for my lack of knowledge in this area that is new for me.
And what commodities do you analyze with your tool?
My tool is mainly based on a growth model and a seasonal model. So any entity that is self-replicating and that lives in a finite environment can be analyzed with my tool. So if you're interested, you can analyze the growth of the human population, or you can analyze the growth of a population of rabbits in the forest. But from an investment point of view, the most interesting things you can analyze here are funds, ETFs, stocks, crypto, basically any commodity that is self-replicating and that has a tendency to grow in time.
Because you mentioned Bitcoin, sorry, you mentioned crypto, and I thought about Bitcoin. Can you please make us a demo about Bitcoin? Show us a little bit how you use this tool and how are you making a decision to invest in the market and also maybe when to sell.
Yes, of course. Now, My tool currently works with Excel files, which I have to update manually every now and then. So let me just load the Excel file. And you asked for Bitcoin, right?
Please. Yes.
Okay, then let me make my model a little bit more conservative so that it doesn't go, it doesn't have the tendency to overestimate things. And here you can see the calculation that my tool does. So it has in blue the growth model, so the tendency for Bitcoin to grow in a void, let's say, and then it has in purple the seasonality, the fluctuations, the long-term fluctuations of Bitcoin. Let me disable these fluctuations just to make the model a bit simpler. Plot it again. And you asked, how do I use this model to make decisions? Now, first I have to trust the model. And what I can show you is that this model tends to be relatively well behaved. For example, if I go back in the past to 2014, and I only look at data up to 2014, I see that my model has a very, very good fit, a very good prediction of what will happen in the future. It's not exactly right, but it's, well, good enough to help me on my decisions. I can go even a bit further in the past, and here you see that the model is not as accurate anymore, but you see that the model tends to converge and not change a lot and make very good long-term predictions. Now, how do I make a choice of when to buy and when to sell? That would be your question. Well, when I see that I'm closer to the lower bound, it's a good indication that it's a good moment to buy. When I see that I'm closer to the upper bound, it's normally an indication that it's a good moment to sell. For example, if I go here to 2014, I can also zoom it in a bit. I am very clearly out of the bounds, and this is in principle a good time to sell. I also have here a parameter, it's called the Kelly parameter, it's based on the Kelly criterion, and I see here that many of my numbers are red. So when I have many red numbers on the short term, it's usually an indication that it's a good time to sell. And when I have many green numbers in the short and the long term, so for example, if I go here to 2015, most of my numbers, or all of my numbers, are now green. So this is also, again, an indication that it's a very good time to buy. Long term. Because this tool is mainly built on a growth model and a very broad fluctuation model, it's really mainly indicated for longer term decisions. So anything above, I don't know, 6 months, 1 year, 2 years, 5 years, 10 years, that's really where this type of modeling shines, in my opinion.
And is it safe to assume that when you have a longer history of the price, you can predict better the future?
Yes and no. A growth model is always based on the interaction between a population, let's say rabbits, and its environment, let's say the forest, right? Now, if you change the environment very dramatically, well, the population will respond to it as well, either by growing a lot or by dying. For example, if you set that forest on fire, well, it will for sure affect the rabbit population, right? So having more data is definitely helpful into having a model that converges better, but the model will only be a good representation of the future as long as the environment stays stable. For example, with Bitcoin, what we can see is that because even moving back quite far into the past, we still have very good predictions, well, then we can infer that the environment where Bitcoin is thriving hasn't changed too much. However, if we suddenly get out of the model and we do not come back into the model, then it's usually an indication that the environment has changed beyond recognition. So yes, having more data usually helps the model converge a bit better, but the model is built on the assumption that the environmental setting will not change dramatically in time.
But also your model, as I see it, is also adjusting to the new changes of the environment.
Definitely. So every time there's more data, the model adjusts. But because this is a growth model, as I said, if we put rabbits in a forest and the rabbits outgrow the forest, they don't have food anymore, so they cannot grow any further. So my model can replicate this type of evolution, right? But if it's a sudden extrinsic evolution, something in the lines of a black swan, as Nassim Taleb would call it, so a sudden and unexpected change in this environment, then the model will have the tendency to fail.
And
At least short term.
And I think we have a black swan in S&P 500, right?
We do. We have multiple, and they're called crises. If I load the S&P 500, let me make it a bit less conservative, plot the current data. For example, here you can see very well, this was the dot-com crisis. This was the 2008 crisis. And this was the COVID drop, that very sudden drop when COVID became widespread.
And now we see also the magnitude between the three of them, right?
Exactly, exactly. So this kind of model is also useful for studying when there is a black swan, when something goes wrong, how does it manifest in this population? And for example, in the case, let's look here at 2008, 2009, what we see, if I zoom it in, is that we fall off of the model, and then gradually we recover back towards the model, and after a few years, basically from 2010 to 2016, we have this recovery period, and we go back almost as if nothing happened, right? So this is, again, what I was trying to explain before. This is a sudden change in our environment, a change that is much more sudden than that seasonality of buying and selling. And as such, it's a change that might have the effect of pulling the data away from the model. But from my experience so far, we see that there's very often this tendency to recover back to the model, at least for sound commodities. So for commodities that have a sound basis behind them, like gold or ETFs, for example.
Although your model might be confused with other platforms for data visualization history, like TradingView, ProTrader, Robinhood, TrendSpider. As you mentioned at the beginning, it is more useful for swing trading and not for intra trading or daily trading, right?
Well, I'm not an expert in those platforms, so I cannot talk too much about them. But what I've seen from them in videos and in playing a bit around with them is that indeed they are very focused on short-term fluctuations. So they use candlesticks, they use different types of models, the crossing of moving averages, etc., to try to infer short-term inflections in the commodity. My tool is almost the opposite of that. Why? Because, as I said, my initial goal was to become a long-term investor, not to become a full-time investor that has to pay attention to a vast portfolio on an hourly basis, but rather someone who can make long-term choices that are a bit more sound. So when you look at the architecture of my tool actually has several sub-models inside it, but they were built from the end towards the beginning. So what I mean is from the very long term, more and more and more towards the shorter term. The growth model is the longest term prediction possible. So as I explained, it's a prediction of how this population will survive in its environment. Then I introduced the fluctuation model, which tries to reflect a bit the seasonality of what's happening around this growth. So it tries to fit a bit the fluctuations around this growth model. You can see it here in. So when we go from the growth model to the fluctuation model, we are basically going from the years time scale to the month time scale. And now I'm also working on a statistical predictor, which will allow us to go even a bit closer into the days or weeks timescale.